Yesterday's FOMC decision came in at no change. So if you're following X or just the broader commentary today, it's either what you're going to hear is nothing ever happens, or what I'm saying mostly is, oh, Warsh is losing control. He's going to lose credibility. That type of framework. But yesterday's decision, like hold rates at 3.5 to 3.75%, basically everything stays steady as is, despite the underlying upward pressure that's hitting or that's wanting to drive money market rates higher. This was the most probable outcome going in. So this was favored 2 to 1, no change, versus the roughly third probability of a hike. Um, like we've talked about on prior episodes, that upward pressure continues to like build. It just may take longer ultimately. Like we can delay that rise from happening for, I don't know, could be months, could be quarters. We'll just have to wait and see how things develop. So, um, like I said, at face value, those two narratives tend to dominate. But I think what we're seeing in the response in the yield curve following that decision is actually your North Star guide to what's actually going on and dominating under the surface. So, just to talk about this for a second, at the front end, when I talk about the front end, I mean money markets, 12, like up, ranging from overnight rates to 1 year maturities for that, defines, we call that the money market. As opposed to everything outside of that, you'd call it the bond market for lending, more broadly. But what we saw in response to front end yields after that decision not to hike was kind of the same thing, and all for all practical purposes, as like a mini version of a rate cut. It wasn't a rate cut, but as we said, that pressure had been building from, I guess we call it the hawkish side of money markets to increase rates. As we've seen, the European Central Bank has already had to give in to that pressure to hike rates as far back as June. The Fed is in a different situation. The U.S. economy is much stronger and has underlying growth to lend into under these prevailing dynamics that these other central bankers do not have within their economies, just to put it bluntly. Um, so what we saw in the front end was as much as a almost 10 basis points taken out of front end yields. If you look at the bottom chart in green, I've got the yields at the end of the day after yesterday's FOMC press conference announcing the policy decision, and then the yellow dotted line is the Treasury curve going in, or at the close of business on Tuesday. So what we saw is 10 basis points almost, probably came in at about 9. For the spot on the yield curve, it's probably about 4 months from now. So if you pace the calendar 4 months, that's roughly November, election day. We'll talk about that in a second later. But 10 bips taken out of the front end, and then a little bit, but that effect kind of dissipates on the other kind of legs of the butterfly in money markets. So that's like I said, that's easing on the front end of money markets. It's almost the same thing as though the Fed had, or as a Chairman Warsh had gotten up and delivered a cut effectively. So what this no change in rates means, like in practical implementation, is that the FOMC will continue to buy Treasury bills. Remember, we talked about last December that transition to the RMP program, Reserve Management purchases, echoing the ample policy or ample reserves policy that the Fed continues to operate. Um, and what that means to hold rates in that corridor means the Fed, or the FOMC, is, or Federal Reserve Bank of New York at the implementation desk, is going to continue to buy Treasury bills. They're going to do that regardless, but they'll do it in a quantity that is greater that, like, had they otherwise allowed rates to increase. So if you think about
I
this,
see.
like the U.S. Treasury needs to raise a certain amount of money every week to keep doing what it's doing. And one of those things it's doing is buying Patriot missiles from Lockheed Martin. We'll get into that at the end of our story. But what this policy actually amounts to keep rates lower, think of it as the mix. Fed is going to come in and support with a higher degree or quantity of bills purchases than it would have had it allowed that policy corridor to rise, which means the load of who's going to finance those the debt expansion that the Treasury needs to undertake to continue running its planned operations uh, for the next, at least going concern up until September, the next policy rate meeting. All of these are going to be live, but that the brunt of that mix, the Fed is saying we're going to keep you know doing our existing lion's share of that private market. That's capacity. It doesn't have to come in, and what you're actually doing there is you're steepening the yield curve, in effect, holding short-term rates lower. The slope of the yield curve incentivizes credit creation within the U.S. economy. You can only keep doing this so long as there's demand from households and corporations to continue financing projects, or for
Right.
households, it could be consumption. But at the end of the day, it comes down to, is the real economy or the private sector of the US economy, do they continue to have robust demand for money, which is by definition credit or incremental credit expansion? So long as you see the US economy hold up, we can maintain this steeper yield curve. So, US economy still in growth mode. Once it flips, right? Once we have to start hiking, that's your sign that we need to, or the US dollar money markets need to raise rates to attract more savings, more kind of buffer into money markets. And what that means is that growth on that's showing up on the longer end of the treasury curve is petering out. All so far, U.S. economy continues to hold up, but this is where your economic data prints, your NFPs, your GDP numbers, all of that are going to become more and more important these next few months. All right, just a quick note about the vote. We got a 9-3 vote, with the dissenters coming entirely from the regional bank governors. So you had Minneapolis with Kashkari, Cleveland with Beth Hammock, and Dallas with Lori Logan dissenting. There could be some political nature to this, but if it was going to be like primarily political, and like I view Neil Kashkari as a political animal, some of these regional bank board of governors are more political, some of them are less. Um, that's kind of obvious. But where the politicization of these voters really shows up, in my opinion, is the FOMC slots. So the 7 on the board of governors. This is where like the Lisa Cook Supreme Court case comes in. All of that jockeying. There's been a lot of discussion about, hey, does Warsh actually have uh, you know control over this board as the chairman? All of that. Could he get outright rebellion if he does X versus Y? With this meeting, you actually did see a 7-0 consensus from the 7 FOMC, or Board of Governors members, which are appointed by the executive, approved by the Senate, all of that. So that's where you'd expect the real politicization kind of effect to show up if there was a lack of consensus within those 7. So for now, at least, this is meeting by meeting. That process of just let's call it polarization, the tug of war for control over the Fed as we're moving into an era of reform on what this institution means. That's still downplayed or on the back burner, which is a positive, and
Yep.
my framework or my opinion. Um, so for now, I'd lean towards those 3 dissents, since they're bank, regional, Fed. The more charitable or favorable and probable explanation behind those 3 dissents is could be that they're seeing the early signs that demand for borrowing is softening in their jurisdictions. So think about that: Minneapolis, Cleveland, Dallas. That's like your interior of the
Interior.
US economy.
Yeah.
It's non-coastal. That's where a lot of the actual real growth is. You could also say it skews towards the south, but you could say Rust Belt revitalization, the reindustrialization of America, all of that process. A lot of data centers going up, all across the country. But all of these effects are spread. You see it on all regional feds, but the fact that you're seeing it from these three, this will be a key thing to watch in the following months. Talked about the data prints, but like I said, we need that domestic U.S. Economic growth um, to continue, and this could be an early warning sign that these regional bank presidents in the survey of their jurisdictions, their member banks are telling them things about what the lending market looks like in their specific neck of the woods. So this is a thing that we all should continue to watch. All right. So a quick look at how markets are pricing policy rate expectations going forward with their hedging activity. Um, we now see a hike fully baked in by the December 9th meeting. So if you look at those numbers, we cross over from the October 28th meeting of plus 0.88 hikes. Then you get to the December 9th meeting of plus 1.278 hikes. A hike is 25 bips. You cross over to the hedging activity is saying like, yeah, that point where we go over, where we get over the hump and the Fed has to give in to this pressure to bring incentivize more savings and private capital into money markets. That crossover point is somewhere between like Halloween and mid-December, which, if you think about this in timelines, when is election day? First Tuesday in November. I don't know the exact number of the date, but very handily, we've seen this in the past, right? Where elections create these deadlines where maybe the direction of interest rates, or Fed rates or Fed policy, purposefully doesn't do anything in that window up into elections. Well, if you're looking for the most probable outcome here, if history is your guide, that decision to hike will be kicked down the road until we get past those key November elections. There's a lot riding on the results. Um, Going forward, I don't think we need to go any deeper into that right here, but it should be obvious to everybody. So that would make sense if you're trying to weigh probabilities here. We've got two meetings. We got September, October, and then a third before the end of the year, December. My base case would be two more of going no change. If the broader economy, the data comes in, all of that market activity, allow two more of these meetings, like to just copy paste what we
Sure.
saw yesterday, and then by December, you would assume that hike, that direction of travel that the rest of the global capital markets are pointing towards, will be forced to materialize. All right. The last note: there was an Easter egg buried in the final question of the press conference that Chairman Warsh took, and there was quietly a bomb dropped that he is only committing to giving these FOMC press conferences through the end of the year. So
Right.
that means three more meetings of hand holding. Then we get the next big step, as it's been clear in the first Warsh press conference in June, and then echoed yesterday. This era of forward guidance is coming to an end, as the revamp and transformation of the Fed as an institution, takes place. This will be a long-term story, but that was quietly a band-aid being ripped off, that I haven't heard many people talking about yet, but
Agreed.
that's important in my book. So we've got big developments in store at the Fed. This was, if you just listen to what we talked about for the last 10 minutes, this was very clearly not a nothing ever happens meeting.